If making good revenues is hard, then making good profits is even harder. Unlike non-profit organizations, every business should obviously make a profit, not only to pay the expenses, but also to keep running the business and grow the business. Because otherwise, the business will need other cash sources to rely on, like investors' money or bank or government loans. Let's first understand the different types of profit through an example of income statement. We start on the top with the sum of all sales, or let's say revenues, by subtracting the cost of goods sold, short COGS, which are all the costs related directly to the production like materials and labor costs. We get the gross profit. Since every company needs more budgets for general administration, operating and sales costs, the remaining profit will decrease and it is called the operating income. The net income is then the result after considering the interest, taxes, depreciation and appreciation, and even further expenses. And the margins are easily computed by dividing the profit by the revenues to get gross margin, operating margin, and net profit margin. As an inventor, try to focus on the operating income for your invention, just to check and evaluate the profitability potential. Even though you are in a big company where the income statement is made for the whole product portfolio, try to estimate the operating expenses and the COGS for specifically your invention and build your mini income statement as if you were in a separate company. In fact, operating income or margin is one of the indexes the investors look for in the early stages of investment and innovation process. Unfortunately, techies think about the invention itself and ignore profit margin, which is the key to build and grow the business and keep improving the offers on the long run without needing to sell equity to get investors' money. The profit margins should be high enough to have better options than the competition, like hiring more people, paying them better, expanding faster in other markets, renting locations near to clients, and growing the production to take advantage of economies of scale and to lower the cost per unit. To be more realistic, the early stages of innovation process are related to high cost of development through trying new things, failing, iterating, and that's why at that state the profitability potential could be not that clear. For that reason, a little study of scalability model could be worth to see what would happen if we 10x or 100x our customers' number. Let's make an example of building a new robot as an invention. To make the first robot, we've burned about $2 million on 10 product development engineers, 1 assembly employee, and raw materials. Well, those costs are very high for the first machine, but if we succeeded to get 100 robots sold, we will not need more engineers because the cost will increase only through the material cost and through 1 assembly employee per 20 robots sold. So you see that the slope of cost curve is increasing with more units sold, and as you see, this curve is not proportional to the revenues curve. And with that, we have a potential scalable and profitable business. Differently, a consulting company that sells consulting hours grows by hiring more consultants who need more devices, working spaces, and operating costs. The business is profitable, but not as scalable as the first example. Not only scalability is an important factor to consider in the early stages of innovation process. To build profitable and sustainable companies, measuring the market demand, focusing on a specific target customer, and differentiating our offers from the competition allow us to increase the profit margin if the customers have no choice, only our offers. To get more information about that, check my video on Porter's 5 forces. I hope you've got value from this video. If you like more content about turning inventions into profitable innovations, feel free to subscribe to this channel. This is Walid. Ciao.